and good afternoon to everyone attending this presentation. My partner Brian Hirschberg and I will discuss considerations for annual report disclosures on Form 20F. My remarks will begin by covering COVID-19 related disclosure considerations when drafting an annual report on Form 20F, and then I will walk through the SEC's recent amendments to the rules governing risk factor disclosures. After that, I will turn it over to Brian to discuss particular risk factor topics that the SEC staff has been focused on recently, as well as key performance indicators and non-GAAP measures, and then recent SEC amendments relating to financial statement requirements for acquired businesses. I will then end the presentation today with a discussion of the Division of Corporation Finance's recent guidance for China-based issuers. Melissa, will you please turn to the next slide? Last year, the global pandemic and resulting economic shutdown occurred while many foreign private issuers were preparing to file their annual reports on Form 20F with the SEC. Suddenly, not only did management and the board have to worry about steering the company through the pandemic, but how to best communicate the situation to investors. Historical financials seemed less likely to provide indications of future success, and the amount of uncertainty in terms of global responses to the virus, varying governmental regulations, and the needs and abilities of suppliers, clients, and consumers made it difficult to provide meaningful forward-looking information to investors. Today, almost 1 year later, there is definitely still a lot of uncertainty, but there have also been lessons learned and guidance provided by the SEC staff and former chairman that can be used to inform disclosure considerations. It seems unlikely that the SEC staff or commission will put out new COVID-19 related guidance before 20Fs are due to be filed, but most of the guidance published last year is still pertinent and can serve as a helpful roadmap as you prepare your filings. Consider whether to provide COVID-19 related information in the following sections of the 20F: risk factors, information on the company, operating and financial review and prospect, controls and procedures, and the financial statement. Next slide, please. On April 8, 2020, former SEC Chairman Clayton and Division of Director of Corporation Finance Director Hinman published a statement entitled "The Importance of Disclosure for Investors, Markets, and Our Fight Against COVID-19." This public statement set forth expectations and provided guidance for companies entering earnings season in the early days of the global pandemic. Detailed guidance was also provided in CorpFin Disclosure Guidance Topic Number 9 and CorpFin Disclosure Guidance Topic Number 9A. In those publications, the SEC staff emphasized the need for companies to provide disclosures that allow investors to evaluate the current and expected impact of COVID-19 through the eyes of management, and to proactively revise and update disclosures as facts and circumstances change. Consider the questions posed in CorpFin Disclosure Topic Number 9 as almost as a disclosure checklist, or during the Disclosure Committee's meeting and its review of the annual report. And read the guidance provided carefully. I'll note that even though certain information may appear to be addressed to domestic issuers only, it is intended to be read more broadly. For instance, CorpFin Disclosure Topic Number 9A discusses companies receiving financial assistance from the U.S. government pursuant to the CARES Act. But a footnote indicates that the considerations also apply to foreign private issuers that receive assistance from their home country. In addition to publishing guidance, the SEC has been closely monitoring how companies disclose the effects and risks of COVID-19 on their businesses, financial conditions, and results of operations. We have also seen comments issued by the SEC staff specific to COVID-19 related disclosure. Again, while certain guidance or comments may be specific to domestic issuers, foreign private issuers should read this published information because you may find it helpful when drafting your 20F disclosures. Next slide, please. I'd like now to turn to risk factors that specifically address risks related to COVID-19. I think the takeaway here should be to not provide generic boilerplate risk factors that could apply to any company. Doing so could elicit a comment from the staff. At the beginning of the pandemic, many companies addressed their risk factor disclosures by including a more generic pandemic-related risk. But as time has passed, the expectation is that an issuer will update its disclosure to provide specific, more tailored risks. I'd like to read an example of an SEC comment that was issued. We note your disclosure that the extent to which your operations may be impacted by the COVID-19 pandemic will depend largely on future developments, which are highly uncertain and cannot be accurately predicted, including new information that may emerge concerning the severity of the outbreak and actions by government authorities to contain the outbreak or treat its impact. Please amend your risk factor disclosure to provide more detailed risks related to the COVID-19 pandemic, tailored to your specific facts and circumstances. For guidance, see CorpFin Disclosure Guidance topic number 9. You should review your existing risk factors and consider whether these should be revised to address events that have already come to pass and to address new risks that have been identified as the pandemic has become more prolonged and its effects more wide-reaching. Consider the impact of COVID-19 as it relates to all risks. Companies have disclosed the risks and impact of COVID-19 not only in risk factors related specifically to COVID-19, but have also disclosed COVID-19 related impacts in other risk factors, including the risks of global economic downturn, changes in consumer tastes and spending, the ability of customers and suppliers to meet their obligations to issuers and third parties, and cybersecurity and data privacy risk. Particular consideration should also be given to risks related to legal proceedings and litigation, risks relating to impairment losses and reserves, and risks related to workforce changes. Next slide, please. The joint statement issued last year by Chairman Clayton and Division Director Hinman provided guidance in advance of earnings release season. The statement urged companies to provide as much information as is practicable regarding their current financial and operational status, as well as their future operational and financial planning. Specifically with respect to forward-looking disclosures, the two noted, we recognize that companies often are cautioned to limit their forward-looking disclosures, and particularly specific estimates, to those required by our rules to limit legal risk in the event the forward-looking estimates prove to be incorrect. In this regard, we encourage companies to avail themselves of the safe harbors for forward-looking statements. The guidance then refers readers to Section 27A of the Securities Act and Section 21E of the Exchange Act. The joint statement noted that historical information may be relatively less significant. That said, investors this year will likely be interested in 2020 financials as a way to compare how companies, especially within the same industry, responded to the challenges or opportunities presented by COVID-19. The former chairman and director also stated that they would not expect good faith attempts to provide appropriately framed forward-looking statements to be second-guessed by the SEC. But while you should endeavor to provide robust information to investors, be cautious. Do not read this statement as some sort of commitment that the SEC will not follow up on your disclosures. There is a lot more to be optimistic about this year with the vaccine rollout, but be thoughtful in how you present that optimism to investors with respect to things like bringing employees back to work, especially given that there is still a lot of uncertainty. Also be aware that the SEC has already brought enforcement actions against companies related to their COVID-19 disclosures. Next slide, please. You can look to these enforcement actions for guidance as well. For instance, the SEC brought an enforcement action against the Cheesecake Factory this past December for misleading investors about the financial effects of the pandemic. The company made statements that it was operating sustainably when it was in fact losing $6 million per week and had only 16 weeks of cash remaining. It had already informed its landlords that it would not pay any rent in April due to the impacts of the pandemic. The company also shared its financial distress with potential private equity investors, but it gave the opposite message to the market. The SEC remarked that when public companies describe the impact of COVID-19, they must be accurate Disclosures should be tailored to the firm and industry-specific effects of the pandemic on the business and operations. And of course, issuers who make materially false or misleading statements will be held accountable. Next slide, please. Just to give one more example from December, the SEC brought an enforcement action against Decision Diagnostics Corp. And its CEO following a trading suspension that was temporary from April of 2020. The company made false and misleading claims in press releases regarding the development of a working breakthrough COVID-19 rapid blood test, when at the time it had no physical testing device and the technology was unproven. The SEC made the point that this is an unprecedented time when the need for truthful disclosures concerning COVID-19 tests is very important. The Commission made clear that it is identifying potential areas of fraud during the pandemic to hold accountable those who exploit the pandemic to harm investors. I think what you should take away from this discussion is that you should use the CorpFin guidance and comments issued thus far, as well as enforcement actions brought by the SEC, to help you draft your disclosures in a way that provides robust forward-looking information, but also in a responsible way. And by that, I mean, don't be overly optimistic and be aware of what you disclose in other contexts. Earnings calls, public statements, discussions with investors. Make sure that your disclosures are consistent. The staff will look at everything you say in the course of the filing review. Next slide, please. I'd like to turn now to recently amended SEC rules. The SEC amended certain items in Regulation SK that affect certain companies. In particular, amendments were made to the disclosure requirements in Item 101, the business section, Item 103, legal proceedings, and Item 105, risk factors. Now, while the changes to Items 101 and 103 do not apply to foreign private issuers unless they file on domestic forms, you should be aware of these changes, especially regarding human capital, as it is expected to result in new disclosure from domestic issuers in their transactional and annual filings that will likely be of interest to investors who have been asking all companies for more ESG disclosures. There is a new human capital resources disclosure topic in the business section, requiring disclosure to the extent such disclosure is material to an understanding of the registrant's business taken as a whole of the company's human capital resources, including any human capital measures or objectives that the company focuses on in managing its business. Now, while Item 101 does not apply to Form 20F, note that the disclosure may be pertinent and it may be relevant in terms of the discussion to the pandemic. So for instance, do you rely on your employees being on premises to work such that the outbreak of infection could materially affect the ability to operate? If so, you may need to disclose that in your risk factors. And some registrants may expand on that disclosure in other sections of the annual report as well. And in fact, the joint statement from the former chairman and director stated that beyond the income statement and the balance sheet effects, we recognize that COVID-19 may significantly impact operations, including as a result of company efforts to protect worker health and well-being and customer safety. The impact of company actions and policies in this area may be of material interest to investors, and we encourage disclosures that address that interest. The same statement specified that company disclosures should, in particular, respond to investor interest in how the company's COVID-19 response, including its efforts to protect the health and well-being of its workforce and customers, is progressing. Next slide, please. I also want to discuss the recent amendments to Item 105 of Regulation SK, which took effect on November 9th, 2020. While Form 20F does not require risk factor disclosure to conform to Regulation SK, it is important to note that to the extent you wish to incorporate your risk factors by reference into registration statements on Forms F1, F3, and F4, you will have to comply with the new requirement in Item 105 of Regulation SK. If that is the case, your risk factor section should be reviewed in its entirety to ensure compliance with the new rule. Specifically, The amendments require summary risk factor disclosure of 2 pages or less if the entire risk factor section in the filing exceeds 15 pages. Disclosure of material risk factors. Note that item 105 previously required the disclosure of the registrant's most significant factors that make an investment in the registrant or offering speculative or risky, and organization of risk factors under relevant headings, in addition to the subcaptions that the rules already require. Any risk factors that would be generally applicable to any company or any investment in securities must be disclosed at the end of the risk factor section in the filing under a separate heading. The amendments are intended to encourage more tailored, company-specific disclosure, so you should keep that in mind when drafting. You should also be aware that in the adopting release for the new amendments, the SEC estimated that absent changes made to future filings in response to the new requirements, approximately 40% of current filers will need to provide summary risk factor disclosure. If your risk factors are currently longer than 15 pages, consider whether to cut down on the length of your risk factor section, or if it makes more sense to keep the length and provide a summary. And with that, I'm going to turn it over to Brian to discuss specific risk factor topics.
Thanks very much, Christina. Appreciate it. So as mentioned, I'm going to continue on our topic of risk factors. Of course, as a general matter, the risk factor section should, of course, focus on the particular specific risks to the foreign private issuer and its industry. However, particular focus historically as the SEC staff has paid attention to risks relating to the nature of the foreign private issuer's business, risks related to the countries in which the foreign private issuer operates, the absence of profitable operations in recent periods, if that's applicable, potential dilution, reliance on management, the absence of a liquid trading market, any unusual competitive conditions, or the expiration of material patents or contracts, amongst other issues. Additionally, if the foreign private issuer qualifies as an emerging growth company, then it should also include in its 20F risk factors covering EGC specific topics. So these include exemptions from certain reporting requirements pursuant to the Jobs Act, implementation of new or revised financial accounting standards, and whether the foreign private issuer has an exemption from compliance from 404B of Sarbanes-Oxley. So next slide. So the SEC encourages issuers to, of course, present risks in the order of their significance. So the foreign private issuer needs to describe those risks that may cause forward-looking statements or trend language that's included in the 20F in other sections to be inaccurate. So this means that each of the forward-looking statements that or language that is included in the 20F that identifies uncertainties or trends needs to be accompanied by information with additional risk factor language. So specifically, the MD&A section contains a discussion of the foreign private issuer's critical accounting estimates and the trends and uncertainties as to the foreign private issuer's results of operations and financial condition. These are obviously subject to the risk of change, and those trends and uncertainties need to be highlighted in the risk factors. So again, those risks that may affect the critical accounting estimates and trends need to be disclosed. Each risk factor needs to be concise and clearly explain how it affects the foreign private issuer. So it needs to be in plain English. Very often, the SEC staff will comment if a risk is not in plain English, or to what Christina was talking about before, if the issuer is using boilerplate language or language that could be applicable to anyone. So that needs to be avoided. So instead, the significant risk factors as they apply to the operations of the particular issuer should be focused on. Of course, the inclusion of any material misstatements or omissions from the risk factor section, whether intentional or not, may subject the issuer and its directors and officers to liability under the U.S. securities laws. Next slide. Okay, so the staff has focused on a number of initiatives related to periodic reports over the years, including 20F filings. So starting with cybersecurity risks, in October of 2011, the SEC issued disclosure guidance on cybersecurity risks. The guidance was intended to assist companies in assessing what disclosure should be provided with respect to cybersecurity risks and cyber incidents, cyber attacks, and how those risks and their impact should be described in SEC filings. So although there's no specific explicit disclosure requirement relating to cybersecurity risks and incidents, the guidance notes that a number of existing disclosure requirements may impose an obligation to disclose an incident. So the risk should be discussed if it's among the most significant risks to that particular issuer and it makes an investment in it particularly speculative or risky. So counsel should consider if the foreign private issuer maintains, for instance, private data, customer data, or other information that puts it especially at risk of a cyber attack. If so, then likely risk factor language is often warranted. Next slide. So next particular hot button topic relates to global security. So the SEC staff has been increasingly monitoring the disclosure of not just foreign private issuers, but also US registered companies with respect to dealings with countries identified as state sponsors of terror. So Cuba, Iran, Sudan, Syria. The SEC's approach has only intensified as the international community has continued to impose stringent sanctions on these countries of focus. So SEC comments that we've seen suggest that the materiality standards applicable to disclosure related to global security are somewhat differentiated and thus require a careful evaluation and analysis by the foreign private issuer. For example, if a issuer transacts with a particular state or country that is under that risk, then all business relations with respect to global suppliers or financial institutions with that country should be addressed, so investors are aware that there could be potential reputational damage to the company as a result of publicity as a result of those dealings. So the foreign private issuer needs to evaluate if there's sufficient disclosure provided and made available to the market of the materiality of its business dealings in any of those countries. Next slide. So beyond those other areas of focus, we list a number of them here, starting with Libor. As we know, Libor is set to be ceased, no longer be published. So as a result, the SEC has issued a number of public statements encouraging market participants to begin that transition away from US dollar Libor. As noted by the SEC, the Libor discontinuance may present a material risk for certain public companies. So disclosure related to that discontinuance could be triggered by disclosure requirements in not only the risk factors, but in the MD&A and in the issuer's financial statements as well. So specifically, transitioning away from Libor could impact the debt instruments that the foreign private issuer has outstanding that currently use Libor, any hedging activities that the issuer undertakes, its valuation models, and perhaps also have potential tax consequences as well that need to be disclosed. The SEC has noted that the secured overnight financing rate, or SOFR, has been proposed as a replacement for US dollar Libor. And so the ARC, the Alternative Reference Rate Committee, the group convened by the Fed, has been the main source of guidance with respect to replacing Libor. So this conversation, to the extent it's germane, should be included in the 20F filing as it specifically relates to the company either adopting the new ARC standard in place of Libor or explaining why it's continuing to use the Libor standard despite the industry transition away. Next slide. So now I'm going to transition to our next topic, key performance indicators, or KPIs. So last year, the SEC issued guidance relating to the disclosure of key performance indicators that are typically disclosed in the MD&A section of an issuer's periodic reports and also registration statements. So for several years now, the SEC's focused and expressed concerns regarding the use of KPIs. This is similar to the concerns raised by the staff several years ago with respect to the use of non-GAAP financial measures. The SEC's enforcement division has in fact taken action in recent years against companies relating to the use of misleading KPIs. Specifically in 2018, the SEC brought enforcement actions and settled against 2 companies and 3 individuals for manipulating certain KPIs. So these are the constant contact and endurance enforcement actions. More recently, last year, following the issuance of the guidance, the SEC charged a global alcohol producer with certain disclosure failures relating to its reporting of higher growth metrics in its KPIs. The order alleged that the issuer failed to disclose the known trends relating to that KPI that was used. So as a result, investors were instead left with misleading trend information that implied a growth in the KPI that was achieved because of increased demand for the producer's products instead of actual unrelated reasons for that growth. So those recent charges over the last couple of years, combined with the recent statements by SEC commissioners and the issuance of the guidance last year, all suggest that KPIs are going to continue to be a even bigger area of focus for the SEC and its enforcement division in the near future. So next slide. So, getting into the specifics on what a KPI is, it's essentially a measurement that assesses a company's performance in relation to a key business objective. So a KPI is often not subject to GAAP and is typically not included in a company's financial statements. Instead, they're potentially subjective and particularly susceptible if an issuer is not being careful to manipulation and, whether intentionally or not, misleading investors. So as a result, the SEC's guidance reminds issuers that when it comes to KPIs, issuers need to include whatever additional information is necessary in order to make the presentation of that particular KPI not misleading. So the issuer needs to consider whether an existing regulatory framework, so Regulation G, for instance, GAAP, SK, whether those apply in the context of the KPI and whether they're the disclosure framework there can be applicable to provide adequate context for an investor to fully understand the presentation of the particular KPI. So specifically, the SEC expects KPIs to have a clear definition and a clear calculation, and to be accompanied by a statement indicating the reasons why the KPI is being used by management and why management feels that it's useful to investors, and a statement indicating how management uses the KPI in its ongoing management and monitoring of the issuer's business. So very familiar to what we're used to for non-GAAP measures for Regulation G. Next slide. So according to the SEC's guidance, an issuer needs to consider whether there are underlying estimates or assumptions for a KPI that is being disclosed. And if so, then the issuer needs to disclose the differences in the way that the KPI is being presented if there are changes, the reasons for those changes, the effects of the change, and any differences that would reasonably be expected to be relevant to an understanding of why the issuer made such a change to a KPI's presentation. So depending upon the significance, it may be necessary to recast prior KPIs to conform to a new presentation. But in any event, the SEC's guidance emphasizes the importance of being transparent and disclosure controls and procedures being adopted in the context specifically to the KPI and how the issuer is deriving information to come to its calculation of it. So the company should review whether it has effective controls and procedures in place to process information related to the disclosure of KPIs to ensure not only consistency, but accuracy as well. So this review should include a discussion with the issuer's audit committee. The audit committee should understand the KPI that's being used, its purpose, its meaning, its definition, why it's how it's being understood by the market, the methodology for its calculation, and whether management proposes or has done any significant changes to the KPI historically. Last point on KPIs is they're frequently also used outside of the 20F in an investor presentation or in an earnings release. The SEC's guidance is clear that the same level of review, the same level of care needs to be taken in relation to the preparation of KPIs in those materials as would be for a 20F or any other periodic public filing. Next slide. So moving from KPIs to non-GAAP measures, as Christina noted, as a result of the ongoing uncertainty related to the COVID-19 pandemic, companies have been faced with a number of financial reporting challenges that result in infrequent, unusual gains, charges, losses, attributable or directly or indirectly to the pandemic. So registrants are frequently considering how are they to reflect these items in their non-GAAP disclosures while being mindful of the various requirements and interpretations related to the use of non-GAAP measures. So an overarching theme of the guidance that the staff issued last year following the pandemic was to avoid any misleading adjustments, of course, whether the measures are used in the 20F or elsewhere. So the staff issued CDIs last year, and they focused on non-GAAP measures that could potentially mislead investors. So when evaluating a COVID-19 related adjustment specifically, the issuer should ask whether it's appropriate as a non-GAAP measure and consider whether the adjustment is directly related to COVID or at least incremental to the normal operations and is a non-recurring adjustment. Is it objectively quantifiable as opposed to a projection or an estimate, which would be inappropriate to use as the basis for an adjustment? So the staff identified adjustments that are likely to be consistent with SEC requirements. Those are related to impairments of goodwill, contract termination costs, such as lease breakage costs, facility shutdown costs, cleaning costs, employee termination costs, salary reduction costs, government grants. On the flip side of the coin, adjustments that are unlikely to be consistent with SEC requirements include estimated lost revenue or profit. These amounts can't typically be objectively quantified. It's not an actual cost or benefit. So others, non-temporary increases or decreases in salary. So expenses, unless they are going to be unless they can be objectively quantified historically, they shouldn't be adjusted. Also, excess overhead as well is typically not an appropriate adjustment. So just as a reminder, registrants must present a quantitative reconciliation of any non-GAAP measure, including one with COVID-related adjustments, to the most directly comparable GAAP measure, and needs to transparently describe and detail all the adjustments that are made. So, and also describe why management finds it to be a useful measure. And since many non-GAAP adjustments will be based on specific fact and circumstances related to COVID, registrants should supplement their non-GAAP measures with detailed disclosures describing and justifying any of those adjustments. Okay, so on to our next topic here. So last year, on May 21st, the SEC adopted amendments to financial statement disclosures with respect to business acquisitions and dispositions, as has been historically required by Regulation SX Rule 305. Through the amended rules, the SEC aimed to improve the quality of information being made available to investors as to the potential effects of the significant acquisition or disposition, and essentially reduce the complexity and cost to disclose that information, and thereby promote capital formation. So among the most important amendments contained in the rules are revising the investment test and income test that's used to determine which business acquisition or disposition is considered significant, thereby necessitating the inclusion of target financial statements, right? And updating the required contents and period coverages of the acquired business's financial statements. Those are the two big takeaways from the amendment. Next slide. So for some background, under the disclosure framework that had been in existence prior to the amendments, when a business combination occurred other than a real estate related operation, which would be Trigger 314 financials. So when a business combination occurred involving a registrant, then the registrant is required to provide separate audited annual and interim pre-acquisition financial statements pursuant to Rule 305. So a registrant measures significance by applying the investment asset and income tests provided in the significant subsidiary definition in SX's Rule 102W, substituting 20% for the significance threshold, essentially. So the specified periods of financial information that a registrant needed to provide depended upon the relative significance of the acquisition to be made. So in addition to filing the requisite target financial statements, Article 11 under SX also required the registrant to prepare and file pro forma financial statements reflecting the acquisition and disposition as if it had happened earlier in time. So next slide. So in order to determine whether the acquired business's financial statements are required, the registrant first needs to determine if the acquisition is significant under 305. So before the amended rules, the investment test considered an acquisition significant if the registrant's investments in the target exceed 20% of the registrant's total assets as of the end of the purchaser's most recent fiscal year. Next slide. In order to closely align the acquisition's economic significance to the registrant where both entities or businesses are not under common control, the amended rules now compare the registrant's investments in and advances to the acquired or disposed business to the aggregate worldwide market value of its voting and non-voting equity. So this is the average of the registrant's market value calculated daily over a prior 5-day trading period. So if that aggregate worldwide market value is not available, then the registrant goes back to apply the investment test that existed prior to the amended rules. So next slide. So in order to avoid immaterial acquisitions from being deemed significant, the amended rules revised the income test by adding a new component. So this is revenues less permitted expenses, which allows the deduction of intercompany eliminations from the target's total revenue from continuing operations when the registrant and the acquired business have material revenue in each of the two most recently completed fiscal years. So therefore, when the revenue component of the income test applies, both the revenue and the net income components need to be exceeded in order to determine whether a subsidiary is significant. So the SEC approved these amended rules, next slide, to limit the historical financial statement requirement to cover not more than 2 years, so it reduced the number of years, dispensing with that third year of 305 financial statements, even for an acquisition that exceeded 50% of significance. And so the amended rules now require financial statements for the most recent interim period rather than any interim period for acquisitions with significance that exceed 20% but not 40%. Next slide. So the SEC now allows registrants to also provide abbreviated financial statements prepared in accordance with the amended rules. So these are audited financial statements of acquired assets and assumed liabilities. This is your P&L, provided the following conditions are satisfied. So the total assets and revenues of the acquired business need to constitute 20% or less of the corresponding amounts of the seller as of the most recently completed year. Second, the separate financial statements for the acquired business must not have been previously prepared. Third, the acquired business cannot be a separate entity, subsidiary, or operating segment, for which then separate acquired business financial statements would be required. And finally, the seller needs to maintain distinct and separate accounts necessary to prevent the financial statements in order to do the abbreviated financial statements. So skipping ahead here, a few slides to the pro forma financial information, I think exactly, yeah, thanks, Melissa. So the amended rules revised also those Article 11 pro forma financial statements that I mentioned. So now the adjustment criteria is broken down into 3 categories. The first being transaction accounting adjustments, which reflect only the application of required accounting to the transaction. Autonomous entity adjustments, which reflect the operation and financial position of the registrant as an autonomous entity if it was previously part of another entity. And finally, optional management adjustments, which allow synergies or dyssynergies of acquisitions and dispositions for which pro forma effect is being given to be presented. So if in management's opinion, those adjustments enhance the understanding of the pro forma effects of that acquisition or disposition, then those can be presented as well. Next slide. So on the next few slides here, we provide some practical considerations with respect to the amended rules. I think in terms of foreign businesses, before I hand it back over to Christina for our last topic, with respect to foreign businesses, the amended rules allow 305 financial statements to be prepared in accordance with IFRS without reconciliation to US GAAP if the acquired business would qualify to use IFRS if it were a registrant. So in addition, foreign private issuers that prepare their financial statements using IFRS to provide 305 financial statements prepared using their home country GAAP are permitted to reconcile to IFRS instead of reconciling to US GAAP. So more flexibility there. And finally, for US business or for foreign businesses, the amended rules also permit an acquired business that would qualify as a foreign private issuer itself if it were a registrant to use IFRS rather than US GAAP when the registrant is a foreign private issuer that uses IFRS. So these rules came into effect at the beginning of this year. So the previous difficulties that issuers, both US and foreign, had in preparing and filing these financial statements for acquired businesses that in some cases adversely impacted the ability of some registrants to access capital markets at certain periods of time before they had 305 financials on file. These changes are welcome and hopefully will substantially reduce or even eliminate the deterrence that in some cases 305 financials have caused when issuers have been considering acquisitions or dispositions. So with that said, I'll hand the presentation over to Christina to cover our last topic.
Thank you, Brian. And Melissa, if you would move forward. Thank you. I see you moving forward. There should be a slide on guidance for China-based issuers. There we go. Thank you. So late last year, the SEC's Division of Corporation Finance released disclosure topic number 10, disclosure considerations for China-based issuers. These are companies based in or with the majority of their operations in the People's Republic of China. With the time we have left, I will discuss the reasoning behind this guidance, the substance, and the implications. While the guidance specific to SEC registrants based in China is new, the issues mentioned in the guidance are not. For example, the SEC staff has for years issued comments asking for more disclosure about variable interest entities. The staff has also issued comments in the past inquiring about audit work papers and whether the PCAOB has access to them. So while the SEC has been aware of these investor protection concerns for years, they have more recently gotten the attention of others in the U.S. Over the past several years, the Trump administration focused a lot of attention on the United States' relationship with China. In June of last year, President Trump issued a memorandum on protecting United States investors from significant risks from Chinese companies. He then tasked the SEC chairman and others with examining those risks and providing recommendations to address the investor protection concerns. One of the recommendations was to increase investor awareness of certain risks by requiring enhanced issuer disclosures. In the disclosure topic, the staff details its concerns that are specific to China-based issuers. For instance, the staff explains the risk that China-based issuers may not provide investors with high-quality, reliable disclosure and financial reporting. Accounting firms that audit SEC reporting companies must share information about those audits with the SEC and the PCAOB. But for the past decade, China has placed restrictions on the PCAOB's ability to inspect or investigate audit firms based in China and Hong Kong. Since the PCAOB cannot inspect or investigate these audit firms or review their audit work papers, the staff cautions that we cannot be as confident in the quality or reliability of the audits of China-based issuers as we can be for other issuers whose audit firms comply with the law. Another risk detailed by the staff relates to China's restrictions on U.S. regulators' ability to oversee China-based issuers participating in the U.S. capital markets. In addition to restricting access to audit firms, China has often denied U.S. regulators access to certain information about China-based issuers themselves. If U.S. regulators suspect that a China-based issuer has engaged in illegal activity, regulators are limited in their ability to investigate or pursue potential violations. China's lack of cooperation makes it difficult for U.S. regulators to bring or enforce actions against China-based issuers and their directors and officers, which means that there may be no remedy for harmed U.S. investors. The disclosure topic also outlines the risks inherent in investing in Chinese variable interest entities, or VIEs. China places restrictions on foreign ownership of Chinese companies in certain industries. In order to circumvent these restrictions, China-based issuers often form non-Chinese holding companies that enter into contractual arrangements with Chinese operating companies. These arrangements are designed to mimic direct ownership. But the division staff warns that risks with this structural arrangement include limited control over the operating company due to the contractual nature of the relationship, as opposed to direct equity ownership, and the potential for the government to determine that the organizational structure violates Chinese law. Lastly, the disclosure topic details the regulatory risks given the uncertainty created by the evolving laws and regulations in China. The staff notes that the laws may be applied inconsistently and unpredictably. After detailing these risks and providing investors with information about differences in shareholder rights and recourse, governance, and reporting associated with China-based issuers, the guidance goes on to ask questions that China-based issuers should consider when drafting their SEC disclosure. The questions are comprehensive and very detailed, focusing on the specific risks outlined in the guidance. As a reminder, this is staff guidance and not commission rulemaking or guidance. That means that these are not mandatory disclosure requirements, but rather reflect the type of disclosure the SEC staff would expect to see when reviewing a filing made by a China-based issuer. Even though these are not prescriptive disclosure requirements, you should expect the staff to issue comments if you do not provide relevant information in your filings. So, if you are a China-based issuer, you will want to read this guidance closely. Do any of the questions asked apply to you? If so, look at the disclosure you are providing to investors and consider whether it is enough or if you need to enhance your disclosure in SEC filings. Consider also, if the questions or risks do not apply to you, should you disclose that information as well to prevent getting questions from the staff on your next filing? That's the conclusion of our presentation.